Welcome to this look ahead to the first week of 2016. January the 4th is the first trading day of that week, although we do get some data out over the weekend on the 1st of January from China. But let's take a look first of all at some of the economic data we've got here in the Euro area. French, German, Eurozone manufacturing numbers, also UK PMI numbers for the manufacturing sector, albeit a small sector here in the UK. German CPI and US ISM manufacturing numbers as well. On Tuesday, German unemployment figures. We got UK construction PMI data and Eurozone CPI. And then on Wednesday, there's a lot of data coming out for services PMI figures, starting off in China. Then we've got Japan as well in the Eurozone, France and Germany. Then a little bit later on in the day at 1:15, we get the monthly private jobs numbers from ADP in the States and a US trade balance, I should say, at 1:30. US ISM non-manufacturing as well. And at 7 p.m. that evening, we get the minutes out from the Federal Open Market Committee, the meeting early December when they decided to raise interest rates. It'll be interesting to see what comes out of that. On Thursday, Eurozone unemployment, Eurozone retail sales, and the weekly jobless claims. And then on Friday, by the time the European markets get underway, we'll have had Australian retail sales and there's UK trade balance. But the big number of the day is the US non-farm payrolls out at 1:30 and also average earnings. David Madden is with us. One of the things that wasn't on that list is the 1st of January release of the China figures. They got some PMI data out. China's going to be one of the big themes for this year. We've looked at it from a number of different angles in 2015, but that certainly seems, as I say, to kick us off next year.
I think China is going to be viewed in a slightly different light in 2016 as it was in 2015 and 2014. The cat is out of the bag, the economy is slowing down, and that was a major theme of the year just gone by, and it will continue to be a fairly big theme in 2016. Beijing have been making a concerted effort to move away from a heavy manufacturing and industrial-based economy to more of a service sector economy, if you will, becoming a truly first world developed economy. So I think there's also a bit, to an extent, lower expectations on China for being this massive importer of commodities that it was a number of years ago in the process of building its manufacturing sector. Nonetheless, high-grade copper and mining companies are going to be very sensitive to any economic indicators coming out of China. So the private survey of Chinese manufacturing coming out in a number of days is going to be a big issue. Looking at this chart here, the high-grade copper has been under pressure for a number of years, tracking the slowdown in China. We're still expecting the Chinese manufacturing sector from the private survey to remain in contraction territory. Now, granted, we have seen soft economic indicators from China recently, and we haven't had the major kind of pull lower for high-grade copper on the back of that, but nonetheless the trend is still there. I would not be looking to call the bottom of this market anytime soon. I think it's the old kind of the same strategy we've had for a number of years now. Any kind of rallies in high-grade copper are points to actually sell into a falling market, but if you do look to try and buy into it, I think it's a very dangerous game.
The other theme next week is Eurozone PMI data, manufacturing and services figures, which will give us an insight into how the sector's feeling as we go out to 2016. What's the tradable opportunity there in that respect?
I think the euro dollar is going to remain in focus in next year. Given that we've had a remarkable bounce back in the euro in December, given that Mario Draghi wasn't as dovish as the market has anticipated, we are now going to enter the new year looking at, right, what's going on with the Eurozone economy? Are the ECB going to be holding steady on their current stimulus package, or are they look to actually going to potentially, or at least talk about extending it or expanding it? Now, we obviously know the problems that can cause, but seeing as it's the euro dollar is against one currency of the two, the US dollar, is looking to actually raise rates further in 2016. The euro could be, even if the Eurozone economic indicators aren't particularly hot and or cold in either direction, I think purely because of the strength of the US dollar in 2016 is going to weigh on the currency. Once again, traders are going to be looking for soft economic indicators from the Eurozone as a sign that, guess what, the ECB are going to have to change their policy again. Very early 2016, I'd imagine the Federal Reserve will be content to just sit on their hands and, quite frankly, pray to God that the small interest rate hike hasn't actually hasn't been a tipping point for the US economy. So initially, we probably could see the euro to be relatively strong in early 2016. Longer term view, Jeremy, is the downward trend we've been in is going to fall into play.
Got jobs numbers out next week as well from the States. I mean, that's obviously a big hot number that the FOMC will be watching. We've also got FOMC minutes from the last meeting. What other aspects of trade should we be watching? The price action on what sort of securities for the FOMC, for example? What
goals one to watch out for in 2016 is going to be probably another difficult year for the precious metal. It's been falling for a number of years in a row now. I think that trend is not only going to continue, but actually probably speed up as we move into 2016. As I just said, the Federal Reserve are probably going to be a bit cautious in the early portion of the new year. They don't want to be in a hurry to raise rates again. But at the same time, they are going to want to see good economic indicators. Unemployment is currently 5%. They want to see that. They want to see approximately at least 200,000 jobs created every single month. And also in the same release, we get actually the wage growth number as well. I think wage growth is going to be a real kind of key issue, because it's all well and good more Americans being in jobs, but actually are they going out spending money? All this, coupled with the minutes from the Fed meeting, which they actually did raise rates, this is all going to be in focus for gold traders, because obviously we've had a gold hitting lows of it was sub 1050 earlier this month. We're going to be looking towards the psychological $1,000 per ounce. The big psychological number is going to be in play in early 2016. And any signs that the United States can, first of all, withstand the rate rise that it has, will then lead on to the next portion of the Fed's monetary policy. When are they going to raise rates again? Probably going to be looking towards halfway into 2016, but nonetheless, while the pressure is on and the US economy is holding its own with a small rate hike that they've already had, gold is going to continue to be under pressure.
Yep. Okay. All right. Let's take a quick skip through some of the corporate data out on the week starting the 4th of January. Nothing on the 4th itself, so we start off with Tuesday. We get traffic numbers out from Wizz Air. There's a trading update from Next. The significance of that is going to be how it fared over the Christmas period. I was in Next the other day. There's a lot of stuff that has been discounted, mostly Christmas jumpers, which people don't seem to have been wearing too much this year. Ford also, we've got sales figures. So we've got Wednesday, a number of companies out on Wednesday, but mostly relatively insignificant. Monsanto is one of the larger companies out with numbers. The agribusiness out with figures midway through the European trading day. It's a Canadian-based company trading in the States. Costco as well, a US-based company, and also looking as well for an update from Topps Tiles on its quarterly earnings. Thursday, this is probably the longest list of the week. Marks & Spencer's updates us as well. Like Next, it'll be interesting again to see just how clothing and food fared there over Christmas. Persimmon, the house builder, out with numbers. EasyJet, traffic figures. Poundland, also in the States, Bed Bath & Beyond. And a look at Friday, just to update you on a couple of companies with numbers out there. Nichols, which owns Vimto amongst other soft drinks, and IAG, owner of British Airways and Iberia, out with traffic numbers. David, in terms of some of the figures out next week, certainly the Christmas period, really interesting to see how things fared. We got figures out from Next and Marks & Spencer. As I say, Christmas is bound to be the big focus of these numbers.
And particularly for both stocks, but if you look at this, the UK supermarket sector has had quite a tough time in recent years. So M&S is probably going to be the one to watch out for. Next to it, still important, but ever so slightly lesser extent. And when I was doing the highs and the 52-week highs and the 52-week lows report, which I run every single day, I've noticed this week and recently that Next has actually been, Marks & Spencer has been popping up on the close to its 52-week low. And you can see there the share price had a pretty terrible 2015. Now, even though M&S tend to actually attract a more kind of middle income shopper, and they haven't really been fully engaged in the kind of price wars that the likes of Sainsbury's and Co have had, the non-food business, the clothing area has been an issue, which has been under a lot of scrutiny, put it that way, from analysts and traders, and it really hasn't been actually performing as well as it should be. And I think the share price really does tell us all that even though the food business is doing fairly well, the clothing sector really, it's kind of general merchandise as they call it, really has been falling behind and has been weighing on the stock. And this will also give us a flavour of how the British consumer has been spending money over the Christmas period as well.
Yeah, quick update on Next. Despite the fact I said what I said about Christmas jumpers at Next, I mean, this is a company which has been delivering almost at every single angle. It's a big dividend payer. I mean, look at this stock price. This is phenomenal. I mean, this is going back to 2012. That's as near as, damn it, a straight line.
It really is. And granted, we've had a pullback recently, which, if anything, just provides an opportunity to buy in. M&S clothing division is falling behind. This is the clothing division that they want. They want to be somewhere in competition with Next. And even though we've seen, granted, a bigger than usual pullback, I do still feel that the stock has had a very good run. And over the year, this has just been going up and up and up non-stop. And I do feel that, if anything, pullbacks in Next are as opportunities to buy, not an indication that the party is over.
I think I'm right in saying Next is now got a bigger market cap than Tesco, which says a lot about the supermarket sector as much as Next, obviously. Yeah. Let's just quickly go through one other company. We've got to talk about Persimmon. Interest rates 2016 is going to be a big thing here in the UK, and these big house builders have been swimming in a wonderful sea of open water in terms of their opportunities, I guess, really, and low interest rates is behind much of that.
Yeah, it really is. And some economists aren't even looking towards 2017 as the first rate rise from the Bank of England. I think it's quite a positive outlook for Persimmon and the rest of the home builders. The only thing that I can say, which ever so slightly negative on the kind of short-term horizon, is obviously George Osborne's change to stamp duty, which comes into play in April 2016. But initially, the first few months of 2016, if anything, we actually could see actually kind of a ramp up in demand to kind of purchase your second home or purchase your property in the UK if you're from overseas, as a way of actually avoiding or ducking the higher stamp duty which come into the early portion of the year. The stock hit an all-time high this year. I do feel in early 2016, given that the low interest rate environment is still very much in play, property in London is going through the roof. But the broader UK housing market is doing quite well. The same old stories. Banks are willing to lend. People are looking to borrow. And on top of that, it just genuinely seems that Persimmon and Co actually can't build enough houses to actually meet the demand that is out there. So any kind of pullbacks in Persimmon, in my view, are worth a buy.
OK, David, thanks very much indeed. Just to confirm, Persimmon out on Thursday along with Marks & Spencer. That's it for this look ahead to the first week of 2016. All that remains for me now is to wish you all a very happy new year and a very prosperous 2016.